Because when you have a business and you're making all of the decisions about where that money goes, what you invest in, what you don't invest in, that is what gets me excited, right? I can run the numbers. I can look and say, is this going to make me money or not? And if it's not going to make me money, I can say, no, my money stays in my pocket today. We're not doing that. If it's going to make me money, I can check the box and say, yes, make that investment, send it off to Amazon or sell it out on eBay or build my own website and then run advertising to run people to that website where they can purchase it directly from me. It doesn't matter. If I know it's a product that is going to make me money at the price I can get a hold of it, because I've already run those numbers, then I can say yes, and I know that I'm going to make money. Buy Black Podcast, episode 27, Comparing Common Investment Options. Why starting a small side hustle business is the best thing you could do when you come into new money.
Welcome to Buy Black, the only podcast dedicated to helping you find, connect with, and support Black-owned businesses. We're on a mission to bring consumers and business owners together to ignite the global Black economy. I'm your host, Gerald Jones, and if you're a Black business owner or a socially conscious consumer, you've joined the right community. Ready? Let's get to work.
Hey guys, welcome back to Buy Black, your only podcast dedicated to helping you find and connect with Black-owned businesses. Today's episode, we're going to be talking about the best way for you to invest new money. And when I say new money, what I mean is for all of us out here in this world who are used to living paycheck to paycheck and making ends meet, doing all those things that we do, you know, every once in a while we come across a nice little windfall of money. And a lot of times we don't know what to do with it. Now, typically the most regular of those windfalls comes somewhere between February and April of every single year. And yes, folks, I'm talking about tax refund time. Most of us put our taxes in a situation where we get a pretty big refund if we play our cards right, somewhere around the beginning of the year. And it can be hard to figure out what to do with that money aside from go out and spend it. So last week, I put out a little bonus episode that only went to the apps that was entitled, Don't Put Your Tax Refund into a CD. So if you haven't downloaded the app, download the app. You can find that episode. And ultimately, the gist of that episode was I was online on Facebook, as many of us are, and having a conversation with a couple of people about tax refunds, what people do with their tax refunds. You know how Facebook conversations go. And a friend of mine jumped on and she was basically saying that, you know, the smart thing for people to do when they get that tax refund money is to immediately go to the bank and put it into a CD. And if you don't know what a CD is, that's a certificate of deposit. Just basically you loaning your money to the bank for a set period of time. And once you've loaned that money to the bank, they're offering you a certain amount of interest to let them keep that money. And they use that to loan out to other people. Well, the friend was saying that this is a good place for people to put their money because it's safe and you know you're going to get a return on it and you know the money's not going anywhere and blah, 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 blah. And it just kind of hurt my heart because, you know, I remember being a kid and growing up and being told, you know, put your money in a CD, put your money in a CD, put your money here, put your money there. And all of it was around this mentality of scarcity. Once you have money, you need to put it in a safe place where you won't lose it. That way, you'll always have it there, right? And I don't like that mentality. As I grew older, as I learned new things, it really came clear to me that having that mentality with money, I got to hold on to what I got when I get it, that is a symptom of our forced culture of you can't go out and create your own money. And the only reason that you are able to have any money is because, you know, I allow you to. We allow you to have this job. We're going to pay you this certain amount of money. And without us, you won't have anything. So you better cherish it when you get it. And that mentality with money is not a wealth mentality. It's not a growth mentality. It's not a creator's mentality. And yeah, I know I grew up with that mentality, and I know that most of the people I've talked to grew up being taught the same thing about money. When you get it in your hands, put it in a really safe place and let it grow over a long period of time. And then eventually you'll be really happy that you put that money there and that you were smart with it. But you don't build wealth that way. You know, wealthy people don't just put their money somewhere. Well, actually they do. You know, really wealthy people do go ahead and put their money somewhere where they won't lose it, because they've actually got money that's worth not losing. Right? Once you get to a certain level, you know, you're talking about $500 million, then yeah, absolutely. I'm just going to put my money somewhere where it's safe, because at that point, even just putting it in the safe place, the interest that you would get is way more than enough for you to live on. But when you're talking about you got $1,000, you got $5,000, you even got $10,000 that's coming to you, you know, putting that money somewhere, quote unquote, safe, where you can't touch it just so that you won't, quote unquote, lose it, is not doing anything for you, because it's not going to draw the amount of interest that it would need for it to someday sustain you. And so it really is just a matter of, I don't want to lose what I got. It's not a good idea. So it was a long way to come around to saying, I laid out in this previous episode all of the reasons why a CD, a certificate of deposit, is a bad place to put your money if you want it to grow, if you want to actually create wealth. And we have to get out of that mentality. And so this episode is going to build on that episode, and it's going to talk a lot more about the things that you have to consider when you're thinking about an investment, where I want to invest money. And then also we're going to talk about the differences. We're going to compare a lot of the common investment options that we run into. And then I'm going to go into a strategy that I recommend for people who are starting off the same way that a lot of us are in, I've got a day job, it pays me enough to cover the bills and a little bit more. But how do I move from living check to check to being financially free? And I've got a strategy for that I'm going to share with you guys today. And actually, I'm going to be talking about a little bit later on this month at a conference as well. So give me that feedback. Let me know what you think about it when you hear it. But not going to take a whole bunch of time talking about this up front. Let's just jump straight into it. We're going to talk about the considerations that you have to have when you are thinking about investing. And I'm sure there are a lot more than these, but these are the major 5 considerations that we should think about when we're going into investing. So the first thing is going to be the level of risk associated with this particular investment. When we talk about risk, specifically, we're saying, what is the likelihood that I'm going to lose my principal when I put money into this investment? If you don't know that terminology, principal, the principal that's the money you start out with. All right. That is the money that you had in your bank account that you put into this investment. That is your principal. The level of risk is how likely it is that you're going to lose that money that you started out with. All right. Level of risk is huge, because when you look at the level of risk, people have different thresholds for risk. Like me, I'm a person who's very risk averse, which means I don't like taking risks with my money. When I put it into something, I want to have a really good guarantee that I'm not going to lose that money. And if there is a chance that I'm going to lose that money, then the potential reward has to be really, really great in order for me to risk that money. And that's the second consideration, is the potential reward, because you should always be trying to weigh out what is the level of risk versus the potential reward when you're looking at investing anything or making any type of decision. In fact, a little bit of sidebar, I talk to my kids about this all the time in the decisions they make every single day. And I mean decisions as little as, walking down the stairs backwards, holding on to the rail because they're small and they do dumb stuff, right? And I catch somebody doing something like that, thinking it's cute. And my question to them is, what is the potential risk of you walking down the stairs this way. And of course they stop. It's like, oh, I could fall down and hit my head. Yep, you could fall completely down the stairs. You could hit your head. You could get hurt. What is the potential reward? What good could come out of you walking down the stairs backwards? Nothing. Yeah, exactly. So if you're looking at a high risk, zero reward situation, why would you do that? It makes no sense at all. So we have that conversation all the time. It's the same exact thing when you look at investing. Am I taking a huge risk with my money right now? And if I am, does the potential reward outweigh that risk that I'm taking? If I'm taking a big risk with my money and there's not a very big chance that I'm going to get a lot of money back off of it, even if it makes a profit, then why would I take that risk? It doesn't make sense. So those are the first two things, looking at the level of risk, looking at the potential reward, and weighing those two. The next consideration, and this is a huge one for me as well as a risk-averse person, you need to look at the level of control that you have with regard to that investment. What that means is, once you put your money in, what control do you have over what happens with that money? Do you just have to hope that something good happens? Or is there any way you can influence the outcomes of what happens with that investment? Great example here. Talk about the stock market, right? Everybody, as soon as you talk investments, the first things people think about is the stock market. Well, if I invest my money into, let's call it McDonald's, right? McDonald's is a publicly traded company. So I go and I buy some shares of McDonald's. How much control over the stock price, the stock value of McDonald's do I have? Absolutely none, right? I could go out and buy a few more Big Macs. I could tell everybody to go start shopping at McDonald's, right? But that has absolutely no impact over what's going to happen with that company. It is all out of my control. Compare that to, let's call it real estate, right? I want to go invest in a rental property. Once I put my money into that rental property, how much control do I have over what happens with that investment? I've got a lot more control over that, right? Because now I have the control over, well, how much am I going to invest in improving this property? How am I going to market this property to try to get somebody in it? How much am I going to charge for rent? Who am I going to rent to, right? All of those things. Am I gonna manage it myself, or am I gonna pay a property manager? Because that's going to affect the amount of return that I'm going to get. All these things, they're things that are in your control. When you've bought a piece of property, you have more control over what happens, whether you keep it and hold it and rent it out, whether you fix it up and flip it and sell it to somebody else. There's all kinds of levels of control that you have, as opposed to if you were just to put your money in the stock market. Right? So looking at that, how much control do I have in this investment type? The next one is going to be really important, tied to what we just talked about: level of effort, level of control, and level of effort. How much work am I going to have to put into this investment in order for me to get money to start spitting back out of this investment? Right? So if I look at the stock market example, how much work do I have to put into my money that I put into McDonald's? Zero, right? If I make a profit, I make a profit. If I don't, I don't. But my effort's pretty much done from the point that I decide to make that purchase. Whereas with a home, obviously the level of effort is going to be huge, right? Any type of property, any asset like that I purchase as an investment, the level of effort that I'm going to have to put in order to start squeezing money out of that thing is going to be much, much higher. And then the last thing that I have written down here is going to be something that I was not able to find a term for it online when I was searching, but I'm fairly certain that this has got to be a term somewhere. Somebody's got to have a term for it. If not, this is a term that I'm creating right now, and that is going to be the velocity of your return on investment. Normally when you talk about velocity, you talk about the velocity of sales or velocity of money, how quickly money flows through some different channels. So here I'm talking about velocity of your return on investment, which is how quickly, once I put my money in, can I expect to start getting money back out? and specifically money that I can get my hands on and I can use in order for me to either make more money or to take care of my family. And that is an important piece because, again, let's use the stock example, right? I bought McDonald's stock. Now, McDonald's is a huge company. Unless something crazy happens, they're not going to have any crazy, McDonald's stock just shot up and doubled this month, or it broke down and it lost, 20% this month, whatever like that. It's a pretty stable company, which means that me putting my money into McDonald's, it's very likely I'm going to have to keep putting money in over time to build up my share of ownership in that. And then as their stock price gradually grows over time, or as they pay out dividends to their shareholders, then I'm going to be getting money back from that. But it's a long-term investment. I'm not putting that money in today expecting that I'm going to see money back out in the near term that I'm going to actually be able to use. It's the same thing when you talk about real estate, right? When you talk about real estate, the velocity of your return on investment can vary hugely on that, because if I'm looking at purchasing a piece of real estate that I'm going to, invest maybe $20,000 in over the next month and a half, get that house completely fixed up, and then I'm going to put it on the market, or not even put it on the market, find somebody else who wants to purchase it and flip it, and then go ahead and get all my money back plus a profit. Hey, you might be able to flip a house in a couple of months, right? Some people may be able to do it shorter. So if you're talking about flipping a house, then real estate, you could get a really quick return on your investment, money that you can turn and flip, put back inside of your account, and then go out and do another flip or buy another property. At the same time, if I'm going to buy and hold, well, now I'm investing this money into this property, and I got to invest money to get it fixed up. Then I got to invest money to advertise it and get somebody in it. And then once I've got somebody in there who's renting my property, I'm going to be receiving a rent check from them every month. And a big part of that check is probably going to pay the mortgage. And then the rest of it is going to be profit. And over a long period of time, then I'm going to get a little bit of profit off of this property. But ultimately, the velocity of that return on investment is going to be really, really slow. If I want to have a stable of properties that are able to actually pay my bills, then I'm probably going to have 5, 10, 15, 20 properties available that I own and that I am renting out. So when you look at that and the velocity of a return on investment, that's going to be a huge thing depending on what you want to do with that money. Money that you put into an IRA, hey, that you're not going to be able to touch that money for another, for me, 30 years. So I'm not putting money in there saying, man, I need to get this quick come up because next month I want to do this or I want to do that, right? So that's the fifth and final consideration when you look at investing. So the level of risk of the investment, the potential reward that you can get out of that investment, the level of control you have over the investment, the level of effort it's going to take for you to start making a profit, and then the velocity of your return on investment. So looking at those 5 considerations, I want to do some comparisons to a lot of the common types of investments that we look at, that people put in front of us. So the first one that I'm going to talk about is going to be your IRA, right? Your retirement account, whether it's a regular retirement account or a Roth retirement account. Differences being, at this point, most of us are probably familiar with the differences between a regular IRA and a Roth IRA. But in short, with a Roth IRA, it's after-tax money. So you pay taxes on that money up front, and then you put it into the Roth IRA. And then that money is growing for however long it's in that IRA, tax-free. And once you go to pull that money out, once you've hit the retirement age, since you already paid taxes on it once, you don't have to pay taxes on it again. And all of your withdrawals from that Roth IRA in your retirement are going to be tax-free. So usually it's going to be more beneficial to you at that point in your life down the line, because you would expect as an older person that you may have larger assets. You may be drawing out a large amount of money from that retirement plan if you've been putting into it for a long time. And so depending on what your tax bracket is at that point 30 years from now, and depending on what our taxes look like 30 years from now, it would be great to be able to just pull money out and never have to worry about taxes, right? Because you don't know whether taxes are going to go up, taxes are going to go down, whatever. So if you got a standard IRA or a standard 401k, then whatever your tax rate is 30 years down the line, and we have no idea what taxes are going to look like in the U.S. at that point, hey, that's what you're going to be paying on that money that you put in way back when. But with a Roth, you pay the taxes based on what the rates are right now, and then you put the money into the IRA after tax, grows tax-free, withdrawals are tax-free. It's all good stuff, right? All right, so looking at those common investment types. In the IRA, what's the level of risk? Well, the great thing with the IRA is that the level of risk that you're looking at is very closely tied to the level of risk that you see in the stock market over the long term. And the deal with the stock market is that it seems volatile, right? When you look at it in the short term, the stock market is volatile. Things can go up, things can go down. We can have a huge crash like we had in 2008, 2009. Or we could have this huge rise the same way that we've had over the last year. But even that, as you see, we're going through a correction right now, and prices are dropping at, $1,000, $1,100, $650, day after day after day. And people tend to panic when they see these massive ups and downs. But with the stock market, you have to look at the long term. And over the long term, the stock market has averaged, I think over the last 30 years, a 7% return. Right? Now, that doesn't mean every year it gets 7%. It means that over the last 30 years, congregated, it's given a 7% return. So the level of risk for that is not very big, right? Because we've seen for as long as we've had this economy that over time it grows. That's what it does. So there's short-term risk associated with it, but because it's in a retirement account that you can't touch the money until you are ready to retire anyway, the risk of that money not growing every year is very, very low. Potential reward is great, right? Because when you tie in your contributions to that IRA, whatever you start off with, whatever your initial principal is, you're going to continue making contributions regularly into that, probably monthly, right? Over your entire career. On top of your contributions and on top of your principal, you're going to get the compound interest on whatever the return is on your IRA. Now, again, that's not going to be a standard set because sometimes you can have a negative return. Sometimes it'll be really high if we've got a strong market. But if we just go with the average and say you get an average return of 7%, and I say 7%, because that is adjusting for inflation, which I'm not even getting into inflation. We talked about inflation in the B episode that I did earlier. So again, go download the app if you have not, so you can hear that episode. But adjusting for inflation over the last 30 years, the stock market has gone up 7% per year. So if we just started that out, right, and we looked at, oh, look at this, what I got on my computer, a nice little compound interest calculator. So if we started out and said that your principal that you started off with to put into your IRA was $5,000, right? Not a huge amount of money. So we'll start with that. And then if we said, and every year I'm going to continue adding to that, and we'll just call it an easy $100 a month, right? Now, some people will be able to put in a lot more. Some people may not be able to put $100 a month into your retirement. But in the interest of looking at the comparisons we have here, say $100 a month you're putting in, so it's an annual addition of $1,200. And then how many years you want it to grow. I'm going to use my lifetime. I'm 35, which means that I'll be able to take my money out when I'm 65, maybe a little bit before that. But again, keep the numbers even. So we'll say 30 years to grow at an interest rate of 7%. And we're going to say that that interest is compounding monthly. All right, so 12 times a year. And if I calculate that, that is going to give me a future value of $162,579.59, right? So starting off with not a whole lot of money, $5,000 is not huge. Putting in $100 a month is not huge. But you do that over 30 years, you get an average 7% return, you end up with $160,000. Now, that is not enough money to retire on by any means, but it does show you that the level of risk on putting money into a retirement, that saying that money's not going to be there when you need it 30 years down the line, very, very low. Potential reward is pretty good, because you don't see a huge amount of money coming out of your check every month. You still have most of your money that you can work with, but on the backside of that, you do end up with a pretty big payday. And if you do a Roth IRA, guess what? You're not having to worry about taxes when you start withdrawing on that when it's time to retire, right? So very, very low when it comes to the level of risk, and the potential reward, pretty good. Now, level of control, you've got a decent level of control there, because you have control over how much money you put into your IRA. You also have control over which funds it is that you decide to buy in your IRA. Because typically when you go into an IRA, you are buying pieces of mutual funds, right? You're getting your money into different mutual funds. So you can choose more aggressive mutual funds. You can choose more stable mutual funds. You can choose ones that are designed for growth. You can choose ones that are designed to pretty much mirror the S&P 500, right? There's all different ones you can choose. So you have a little bit of control over that investment. Ultimately, just control over which funds you decide to buy in there and how much money you add every single year. If you want your money to grow much bigger, hey, you can put more money into it. A great example here, let's just say that instead of putting in $100 a month, you decided that you were going to put in $250 a month, right? So $250 a month times 12 months. So you're going to make me do public math here. So that's $2,500 plus plus another $500. So that's $3,000. Hey, that was easier than I thought, right? So $3,000 that you're putting in instead of $1,200 for a year. $3,000. Still 30 years to grow. Still a 7% interest rate. Still compounding 12 times a year. And that money is now going to be $345,575, right? So by adding in another $150 a month, you're going to more than double the amount of money that you're going to have in your future value, right? So that's plenty of control that you have when you're talking about an IRA. Level of effort, not very much. You can set it up saying, hey, company, I want you to take this amount of money out of my check every month, put it towards my IRA or my 401k, whether it's a Roth or whether it's traditional. In either case, level of effort is going to be very low. And then looking at the velocity of return on investment, that's going to be very, very low, because you will not be able to touch this money without losing a big chunk of it to a penalty for however long it is before you retire, right? So very low velocity return on investment. All right, so the next thing that we have on our list here to compare investment options is a fairly new one, and one that I don't know much about, which is why I don't play with it. And that is the cryptocurrencies. You know, Bitcoin has been out for a while, and it's had its ups and downs. It's had its time period where it was brand new and everybody was kind of afraid of it, not understanding what blockchain technology is. And, it just kind of stuck around and it grew. And then here, maybe a month or two ago, we saw it was having this huge bubble. I think it jumped up to like $14,000 a coin, and people were projecting it to go up to like 20,000. Everybody's been getting into these cryptocurrencies. And then you've got all the copycat currencies that are coming out now. I think I've seen like Ethereum and a few different ones, right? And everybody's trying to get in early. They're saying, oh man, I missed Bitcoin, but there's a new coin coming out every single day. And if I can get in while it's super cheap, this is projected to go way up, and then I can turn my $1,000 into $30,000, right? That's the big thing right now. Everybody's trying to get into crypto. And even in that, I mean, we see that, as the stock market started taking its dip this last couple of weeks, Bitcoin took a huge dip, way bigger dip than what the stock market did. And that's the issue with these cryptocurrencies right now, is that they are extremely, extremely volatile, right? Very, very volatile. Price can shoot up and the price can drop out completely, and you have zero control over that. So let's go down that list of considerations when we talk about cryptocurrencies. First thing, level of risk. Level of risk is huge with cryptocurrency right now. Bitcoin is the most established cryptocurrency, and yet its price can jump and drop by thousands in a matter of a day, right? That is hugely volatile, especially for people who don't have a lot of money to invest. If I'm coming in and the only money that I've got is $5,000, right? And I'm putting that into a cryptocurrency. Now, tomorrow, that cryptocurrency could double. Literally, it could double in price tomorrow, and my $5,000 could become $10,000. The problem with that is, if I just pull my money out when I get that $10,000, I might be missing out on when it goes up to $15,000 the next day. Or I might have pulled it out just before it dropped out of the bottom and the $5,000 I put in is only worth $1. You never know. And because it is such a volatile market with cryptocurrencies, you never quite know when the right time is to cash out, right? You never know. And that's why people get so panicked over cryptocurrencies and the stock market. You have zero control. But there's this thing that is just the price is going up, 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 and then it drops and people get scared. And then it drops even further and people start selling. And then it goes all the way back up and you just have no idea what's happening. So your level of risk with that is just crazy. Potential reward, also crazy. I mean, with these cryptocurrencies that are coming out now, you might have one where you can buy, you can buy coins for, a few bucks, right? And then a month from now, those coins that you bought for a few bucks might be worth, a few $100. That's a huge return, right? If I had $5,000 and I was able to buy coins that were, let me do a little bit more public math here, all right? Let me get my calculator. And I got $5,000 and I want to buy a coin, and each one of these coins is, let's see, I'll use Ethereum right now, because that's the one that I heard of that's not Bitcoin. Ethereum price today. All right, so right now, Ethereum's price is at $850. $850 a coin. All right, so, you know what? Let's not use that one. Let's use Litecoin. Litecoin right now is $155.05 per coin. So if I was to take my money and take my $5,000 and I'm going to divide that by 155.02, that is 32 and a quarter coins. So I can buy 32 coins, right? So I buy 32 Litecoins with my $5,000, right? And then let's just say that, let's look over here real quick. Let's just say that Litecoin a month from now is worth $400 a coin. All right, let's just say it went up that much. $400 a coin a month from now. So take my 32 coins times 400. And that's $12,800. So in 30 days, I could turn my $5,000 into $12,800 with this Litecoin, right? If it was to go up and basically more than triple in price in 30 days, which we've seen crazier things happen with cryptocurrencies. However, if we were instead, and see, this is a great example right now. I'm looking at Bitcoin. Bitcoin right now is at $8,500. It was just a couple of weeks ago that Bitcoin was at like $14,000 or $15,000. So it's been cut in half basically over the course of a couple of weeks. And this is the major coin that's out there. All right, but same time, if Litecoin decided it just wanted to drop out of the market. Like I've seen right here on this little thing, it's showing that it's gone up, down, it's going up, down. Let's say that it decided to drop itself by a third, right? So now each coin is only worth $100 and I got 32 of them. So now I've only got $3,200. And what is it that's going to keep that coin from dropping? What is it that's going to make it skyrocket? I have absolutely no idea. What can I do to keep me from losing my money? Absolutely nothing at all. What can I do to make sure that, hey, if it goes up, that I sell it at the peak and I don't sell it before it continues going up? Absolutely nothing. I'm stuck, right? I have zero control over that cryptocurrency. So level of risk, super duper high. Level of reward, potentially huge. However, I have no control and I'm going to be in a panic mode. I'm constantly looking and checking to see, oh, what is it saying? Is it supposed to go up? Is it supposed to go down? Should I cash out now? And the odds are you're going to make the wrong decision. You're going to cash out when you should have stayed in. You're going to stay in when you should have cashed out. And to me, it's just not worth it. It's not worth the stress on my heart for something that is so risky. All right. Level of effort, technically very low. But again, when you're dealing with something that is so volatile, you constantly have to be looking at it. You have to become an expert of sorts. And even with that, there's no way you're going to be able to become an expert at home, but you have to become an expert of sorts of looking at these things and trying to figure out when to do what with your money. Because you get just hugely excited when you'll see my investment quadrupled itself overnight. This is crazy. But then you'll see it drop, by a half or a third, and you start panicking, and you never know what the right thing is to do, right? So you have to put time and effort and energy into watching that investment if you want to make sure that you don't lose on the investment. The only option that potentially works is to just put it in there and leave it alone and forget about whether things are going up or going down. The problem with that is that not every one of these cryptocurrencies works. And you might put your money into one that just dies, which means every single penny that you put in there is gone. This has happened with stocks before. It's happened with companies that just completely go out of business. So that risk is completely on you, right? Velocity of return on investment is crazy, right? Again, over a couple of weeks, Bitcoin went from 14,000 to 8,500, which is what it's at right now. Over the next couple of weeks, it could jump back up to 14 or 15,000. So the velocity of return on cryptocurrencies can be crazy fast. The question is, when do you sell it? If you happen to buy on a day right before the price jumps, and then that next day your money is worth 3 times more and you cash out, hey, that's a ridiculously fast return on your investment. The velocity of your return on investment is major. However, the velocity of the time that you lose money could be major as well. Because you could put your money in and then the next day it just drops by half like Bitcoin did. And all that money is gone. Now, what do? Do you put more money in to supplement it? Or do you just hope that your money comes back? Or do you cut your losses and take that money out today and say, I'm not playing that game again? You just don't know. It's just too much to it. So you guys can probably hear in my voice, I'm not about playing those games, right? If I don't have control over it and if it is extremely volatile, I don't want to play that game. But those are the things with cryptocurrencies. Now, the next one I have on here is single stock trading. That is the exact same, right? Single stock trading is basically the same as doing cryptocurrencies when it comes to level of risk, potential reward, level of control, level of effort. Because with a single stock, your money is dependent upon the management of a company, and you have zero control over how well the executives manage the company that you've decided to buy a share of. So putting your money into a single stock is extremely risky. The reward is usually okay, right? It's nowhere near as potentially good as a cryptocurrency, unless you're putting your money into a company that like just went through an initial public offering or IPO. And you're expecting that the value of that company is just going to skyrocket because now they're selling shares to the public, which is going to raise a whole lot of capital, which is going to give them the ability now to invest in new products, new services, new ways for that company to succeed. So that's one potentially high return that you can get when you're getting into a company that's just about to IPO. But if you're just going in and saying, hey, I want to start buying some McDonald's stock. I mean, yeah, McDonald's is pretty stable, but that also means that however much money you put into it, it's probably not going to go up a lot. It's probably not going to go down a lot. It's McDonald's. It's there. It's going to be what it is. Same thing with a Walmart or a Target or some other major company that just kind of exists out there. It does its thing. It's slightly bigger. It's slightly smaller, but ultimately, you're not going to see a lot of reward on it. All right. But yeah, so comparing that to cryptocurrency, level of control, same thing, nothing. Level of effort. Now, level of effort, again, if you're dealing with a company that just IPO'd, or if you're trying to, luck up on some penny stocks and hope that they're going to, skyrocket, then you got to put in the effort to watch these stocks, watch the companies, and decide where to put your money. It can be a full-time job. That's why there are entire industries of people who get paid to do nothing but watch these markets and give people advice. Velocity of return, again, depending on where you're putting your money. If you're putting it into a stable company like a McDonald's, hey, your return on investment is probably not going to be very fast, right? You're putting that money in there, it's going to be there. However, if you're investing in penny stocks, you could very easily lose all your money. You could very easily triple, quadruple your money. It just depends on picking the right ones. So that velocity of return could be really high, but again, very, very risky. And the potential reward, it might weigh out for you. For me, it doesn't. All right, so the next thing is mutual fund trading. What's the difference between buying single stocks and buying mutual funds? Well, a mutual fund is literally just a huge fund that is made up of different stocks. And the whole reason for having a mutual fund is that you are able to diversify out a lot of the risk, right? There's individual risk for a stock, for a company to either do well or not do well, for that stock to go up or go down. But then there's also market risk. There's no way that you can get rid of market risk. Market risk is what we're dealing with right now. Hey, the market has been going up, 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 up. And now across the board, it is dropping 1,100 points today, 600 points today, 400 points today, another 800 points today. Doesn't matter how great a particular company is doing. When the market itself is going through a correction, then pretty much stocks across the board are taking a hit on their price because of the hysteria that people have. It's like, oh, the market's going down. I need to sell everything I got right now while it's still got value. So you cannot do anything about market risk, but you can do something about the individual risk of only owning one stock. Like if I only own McDonald's stock, then I am at the mercy of what happens to McDonald's. But if I own McDonald's and Starbucks and Walmart and Target and Facebook and Google and all of these different stocks, and I have a little bit, some shares in all these different companies, and that's where my money is spread across, then I have been able to diversify out a lot of the individual risk, because if one of those stocks does badly, it's likely that a couple of the other ones are not going to do as badly. And so my money is going to level out, hopefully in towards the positive. So mutual funds are less risky than single stocks. Looking at the potential reward is still great. Because I do have my money across so many different companies, if the right company has a great year or if the market goes up, my money is going to grow. Level of control, again, it's kind of like having your IRA. I can choose which mutual funds I want to invest in, and different mutual funds are made of different companies that are designed around either growth or stability or international, all these different things, right? So I have a little bit more level of control. Level of effort is not so high, because usually if I'm getting a mutual fund, I am paying somebody else in order to manage that mutual fund for me. And that is another one of the issues, is that mutual funds require fees. So however much money you're putting into your mutual fund, there's going to be fees that are going to come off of that, either on the front end or on the back end. And so that's going to adjust the amount of your principal that's actually going towards your investments. So always keep that in mind. And then velocity of return on investment, again with mutual funds, since it's not a retirement account, then there's no issue of I can't touch my money for the next 30 years. However, at the same time, you go into your mutual fund, hey, I want to take money out of this. Okay, great. So we're going to take our cut for our fees for doing our job of helping to manage your money in this mutual fund. And then you're going to get your cut that you are drawing out of your mutual fund. And then the government is going to want its cut. If you made any gains, if you made any gains on your principal, then you're going to pay capital gains tax on that. And then whatever is left, that is what you get. And you can get access to it, fairly reasonably quickly, right? It's not a matter of, hey, 6 months from now you can get your money. You can get it pretty quickly, but understand that whatever the gains are, the government's taking its piece, the fees are taken out, and you're getting what's left on that. All right, so not bad with mutual funds. Next place that people commonly like to invest money, real estate. We've talked about real estate investing. Real estate, especially when we talk about investment, it can be so many different things, right? Investing in real estate doesn't just mean I buy a home and I rent it out and I keep it for 30 years or whatever. And it doesn't just mean I go out and I start flipping houses. And it doesn't even just mean, hey, I need to have a huge amount of money in the bank in order for me to even buy a piece of real estate. There's a lot of different ways to deal with real estate investing. What I would say with that, though, is that no matter how you get into real estate investing, if you think that investing in real estate is going to be a way for you to get passive income, which means a income that requires a very low level of effort, you're extremely mistaken. That's one of the biggest problems people have. They think, well, I'm going to get a rental property and I'm going to get somebody to start paying my mortgage, and I'm just going to set it and I'm going to forget it. I'm going to get the rental income every month. It's going to pay the mortgage, and there's not anything that I have to do. And that's just not true at all. There is always work. There is always an expense. There's always something. I guarantee you there's always something that's going to be going wrong at that house. And either you're going to manage it yourself, or you're going to pay another company to do that for you, which is another expense that's going to be coming out of your profits from owning that property. So no matter how you look at real estate investing, especially early on in your life, if you're trying to build wealth, you might as well look at that as starting a business, because you're going to be putting in a lot of work and a lot of effort. So we look at real estate investing on our 5 considerations. Level of risk. With real estate, it depends. It depends on the property. It depends on the market. It depends on the location. It depends on everything, right? It depends on what type of real estate you're trying to get into. Are you doing wholesaling? Are you doing buy and flip? Are you doing buy and hold? There's all different ways to do real estate, and your level of risk is going to be different from each one of them. Same thing, potential reward. Wholesaling properties, which is something I haven't talked about here yet, but you can read up on it. Basically, with real estate wholesaling, you go out and you find people who are motivated to sell their home. You get them to get under contract with you to sell that home to you at a huge discount to the value of the home. And we can talk on a different episode about why somebody would be motivated to do that. But once you've got that home under contract, you connect with people who buy homes, which you would already have connections with if you were in this business, and say, hey, I've got a property that I've got under contract over here. Well, you don't tell them you have it under contract, but you got a property over here that you can sell them. It's in the area that they like to buy. It's the type of home that they like to buy, and you'll sell it to them at whatever this price is, right? So then they say, yep, I want to buy that home. And then what you'll do is you go and you close on that home with the original seller at a certain price, and then you turn right around, usually that same day, depending on what state you're in, and you close on the person who's buying that home from you at a higher price, and then you pocket the money in the difference, right? So if I was able to get this person to sell me their home for $20,000, and then I was able to turn around and sell it to another buyer for $35,000, well, guess what? I just made $15,000 in a day. And deals like that happen, right, with wholesale real estate. So velocity of return on investment, I could make a return in 72 hours on a certain type of real estate transaction. On the other side of that, like we were talking about earlier with a buy and flip, I could buy a home, put another $20,000 or $30,000 into it and building and fixing it up, then turn around, put it on the market, sell it, and then I will make that difference when it sells. So that might be 3 or 4 months for me to see a return on my investment. Or if I'm buying and holding, I fix it up and then I put somebody in it and that person starts paying my rent or paying rent to me, paying my mortgage, paying me a little bit extra on top of that with profit. And I do that with multiple different properties. And over time, I'm going to start seeing a positive flow. So it's a much slower return on investment velocity when it comes to real estate. The key thing with that, though, looking at real estate, is do not get into it thinking that it's a passive income. Real estate investment is not a passive income. It's work. It's a business. And you're basically starting a business. All right. And that leads us to the last component, the last thing I want to talk about tonight when it comes to investment options. And that is going to be starting a business. Should have seen that one coming, right? Starting a business is another investment option. And I'm going to specifically talk about starting an e-commerce business because today in 2018, we have the ability to start businesses in ways that we never could have done it before. For some strange reason, in the Black community, we are still living in this world of I've got to have $25,000 to go start a business. And I got to have 6 months of my expenses in the bank before I can start a business. And I've got to have this and I got to have that. And I got to get a lease on a location and I've got to get these things. And all this money I've got to spend to start a business. We still think that it's like 1995 or something. And it is not like that. And we're the only community that still has this mentality about starting a business. Like, I've got to have money to make money. Guess what, y'all? In 2018, you do not have to have a lot of money to start making money. That's the beauty of technology. Starting a business as a side hustle is a great way to invest new money, right? Let's take a look at that. Specifically talking about an e-commerce business. The level of risk on running an e-commerce business. The level of risk can be mitigated based on how well you choose the product that you want to sell or products that you want to sell, right? You can go and you can do some research, and that research does not cost any money to figure out what types of products people are looking to purchase. Whether that's on Amazon, whether it's on eBay or any of these other sites, you can do research to figure out, these are popular products that people want to buy. And so you can lower the risk of failure with your investment by doing a little bit of research to figure out whatever product I want to purchase and sell, I need to make sure that it's one that is already popular. And then when you invest in that product, you already know people will buy it because you see that they're already buying it from other people. All right. So level of risk, low. Potential reward, massive. Potential reward is huge when it comes to doing an e-commerce business. Now, you guys, if you listened to episode 20 of this show where I was talking to Curtis May about prosperity economic principles, I told a little story about one of my recent business ventures that I did. I basically went out and I found these audio Bibles at a store that was going out of business. I made a deal with the liquidator to purchase all of them. They had 137. I bought all 137 of them for $6 a piece because I already knew that they were selling online at $25 a piece. Well, by the time that I purchased them and I went to sell them online, they were actually selling at $30 a piece. So, and I knew because I looked at the Amazon sales rank that it had a sales rank that was below 10,000 in the books section, which meant people were buying these things left and right. They were buying multiple of them a day, and they were buying them at a price that was 5 times higher than what I was getting them for. So I already did the research and knew this is a good investment, right? There is a very low risk that I'm going to purchase these and nobody's going to buy them from me. And there's a very low risk that I'm going to purchase these and I'm not going to be able to sell them at a profit because I already saw what they were selling for and I already knew what I was buying them for, right? But the potential reward was massive because what I spent on that investment was less than $1,000, right? It was about $800 that I spent on that investment. And then I put them up and put them online to sell on Amazon. Sent them out FBA, so fulfillment by Amazon. If you heard one of the other episodes talking about Amazon fulfillment, I did that, shipped them off, and then I forgot about it, right? Once I put those in my inventory and I shipped them off to Amazon, everything else was on Amazon. When people bought them, Amazon took it out of the warehouse, put it in a box, shipped it out to people. I got paid my money. And over the course of 30 days, what was an $800 investment for me turned into almost $3,000. Right. So I more than tripled my money in a month. Now, was there a potential for me to go out and quadruple my money or quintuple my money on that same investment? No, there wasn't. There was a cap on it because I knew how much it was worth to buyers and I knew how much I paid for it. But think about the power of that. Before I ever spent a dollar, before I ever invested a single dollar, I was able to find out how much is it going to cost me to get this, how much is it selling for over here, and what is my profit going to be in between, and how quickly can I expect it to sell. I knew the answers to all those questions before I put a single dollar on the table, and then 30 days later, I tripled my money, right? Now, that's not huge money that we're talking about, right? But going from 800 to 3,000 in a month, and the only thing that I had to do was go to a store, work out a deal with somebody, pay them some money, they gave me the product, I put the product online, I shipped it off to Amazon, and then they did the rest of the work. People bought it because we knew that they were going to buy it, and then I got paid my money. That's power, right? Tripling up your money in a month is power. Now, what I did with that, again, why e-commerce business is such a great potential reward. When I got paid that money back from Amazon, I immediately turned around and I had a product already that I had purchased samples of, that I had sold the samples of online. And within about 5 days, I sold out of my samples and I doubled my money on the samples, which the cost to get those samples was a lot higher than if I had bought a larger volume. And we can talk about all of that later. But ultimately, the whole point is I already knew that I had a product that was going to sell, that I could purchase directly from a manufacturer at a certain price once I had the money. So I used the money that I got from my sales of these audiobooks, and I turned around and I made my first order with this manufacturer of the other product. All right, so that product is headed into me right now. And from that investment, I'm looking to triple my money again. Only now, tripling that money is not tripling $800. It's going to be tripling $3,000, right? And I'm looking to be able to triple that money in less than 60 days. And then it's a product that I already know that I'll be able to go back to that manufacturer and get again. And I'll be able to triple it again and again and again and again. And over the course of this year, I'm projecting the ability for me to turn that initial investment of a few grand into that one product into somewhere around 30 to 40, right? Over the course of the year, 3 grand turned to 30 to 40 grand by the end of this year. Now, if we're talking about a business that's going to support employees and a business that's going to, grow exponentially, that doesn't sound like a lot of money. But when you talk about my household, right? Talk about your household. If you have a job that is paying your bills every single day and is covering everything, and then you can start a business on the side that you can start with a little bit of money, and then in a year, it's bringing an extra $30,000 into the household, completely separate from the other money that's coming in. Does that sound like a good deal? When you compare that to the potential of an IRA, let's just say, all right, let's just say here, we use the exact same thing that we had with the IRA, and we started out with that $5,000. We were able to go ahead and put in the higher number, $250 a month over 30 years, and we turned that into $345,000 over 30 years. Let's turn that around and let's just say that you made the same investment that I'm making, right? You put $3,000 into a product and you project based on the velocity of sales of this product, based on the profit margins that you have in this product, that you're going to be able to basically make, let's just call it a $30,000 profit every year. Right? That's not growing the business. That's not adding any other products. That's not scaling up. It's just staying the same. Just saying, I know this is going to throw me a little bit of money every year. So if I take $30,000 in profit every year times 30 years, that is $900,000. $900,000. So that's 3 times as much money as if I were to just put $5,000 into the bank or into my IRA up front and then add $250 to it a month every month for the next 30 years. Or I was to take $3,000, find a nice product that I could purchase, turn around and sell it, make a 300% return on investment, and then do that every 60 days over the course of a year, putting me at about $30,000 profit a year. Doing that with no larger business over the course of 30 years, you're going to make $900,000. You're going to triple that money, right? From what you would get from an IRA. Now, that is considering, again, I'm not growing. This is just me saying, I'm going to do this little thing with this one product on the side, and I'm not doing anything else. I'm living my life. I'm going to my job every day. I'm paying all of my bills, and I've just got this one product that I sell online. And whenever I get low, I reach out to the manufacturer and I get more of it. And I let my money and retained earnings just grow and grow and grow. I may invest that money into an IRA or wherever I want to put that, right? But the point of the matter is that having a business is the most profitable thing you could do with the money that you have coming in, because profits are the things that are going to make you a fortune. Right? I think Curtis said that in our show. Profits make you a fortune. So level of risk, low, because if you're smart, you find the right product and you go out there, you market it right, you price it right, and you make a profit. Potential reward is huge. The potential reward is 3 times higher. And again, I'm using fixed numbers here. Somebody could come in and they could look at all these other factors. I'm keeping it simple, but it's 3 times higher, right? Than if you were to put your money in an IRA. You can make a lot more money that way. Level of control is 100%, because when you have a business and you're making all of the decisions about where that money goes, what you invest in, what you don't invest in, that is what gets me excited, right? I can run the numbers. I can look and say, is this going to make me money or not? And if it's not going to make me money, I can say, no, my money stays in my pocket today. We're not doing that. If it's going to make me money, I can check the box and say, yes, make that investment, send it off to Amazon or sell it out on eBay or build my own website and then run advertising and run people to that website where they can purchase it directly from me. It doesn't matter. If I know it's a product that is going to make me money at the price I can get a hold of it, because I've already run those numbers, then I can say yes, and I know that I'm going to make money. Right? So level of control, huge. Level of effort for an e-commerce business as compared to most other businesses is extremely low. Now, compared to these other investments, yes, level of effort is going to be higher when it comes to running an e-commerce business. But compared to running a a storefront business or compared to running a service type business, the level of effort is very, very low. You know, for me, either I'm selling my product on Amazon, which means that once I get it to my home, I check the product, I make sure that I got the quality that I was supposed to get, and then I box it up and I ship it straight off to Amazon, right? And they hold it in their warehouse and they put it up on the Amazon store, and when somebody buys it, they ship it all out. I just get my check, right? So level of effort for that is very, very low. I got to deal with manufacturers. I got to make sure that I work those deals out, but once I pay my money and get my product, that's done. I got to check the product. I got to box it up. I got to make sure that it gets to Amazon. Once I get that shipped out to Amazon, that part of it is done. And then I just have to wait to get my money in. If I'm selling on eBay or another platform, level of effort is a little bit higher, because once it gets to my house, I set up the eBay, listing. And then as people buy, then I have to ship it out. So level of effort is a little bit higher, but it's still the same. Somebody else is managing that payment. Whenever I ship the product out, it's already been paid for by the customer online. So I know the money is there, and I just see that money continue to grow on my account. In either case, e-commerce business, you find the right product, you test that product, make sure people are willing to buy it at the right price. The level of effort is low, level of control is high, level of risk is low, potential reward is huge, and velocity of return on investment, it is massive. Right? I told you guys, I put $800 into one product before Christmas, and over the course of 30 days, that money turned from $800 to $3,000. 30-day triple of my money? Yes, that is a super fast return on investment, especially when all the work I had to do was talk to somebody on the phone to negotiate a price, go down there, pay for the products, get them in my truck, get them back home, check them all, make sure that they were ready to, that they were not ripped up or torn up or anything like that. I think there was 3 of them that I'm still looking at here in my office that I didn't want to send in because they weren't in best condition. So I ate that, right? But ship it all out and then wait for them to sell. And then 30 days later, I had a lot of money. It was nice, right? So velocity of return on investment is as quick as you can sell your product. And you can speed up that velocity by doing things like paying for pay-per-click advertising, or marketing in different ways, or putting your product in multiple different locations like Amazon and eBay and your own website. So you can speed up the velocity of your return, the velocity of your sales, and the faster that you sell through your product, the quicker you can reorder from the manufacturer, the more money that you can make. I mean, this product that I've got that's coming in, when I sold through my samples, I sold through all my samples in 5 days, and that was without using any advertising, right? I didn't pay for any advertising. I just happened to have a product that people were already searching for, that they were wanting to buy, and that they were paying me for very quickly. But if I was to pay for advertising, and let's just say that advertising may cost me, let's call it a third, right? A third of my return. I don't think it would, but let's just say it does. So instead of making, say $9,000 in 90 days, was it 90 days or was it 60 days? Let's call it 90 days. Instead of making $9,000 in 90 days, I'm only making $6,000, but because of the advertising, I'm making that $6,000 every 30 days, right? So that means that every month I'm bringing in $6,000, right? So if I was to do that, then I would take 6,000 times 12, which means in a year I would be bringing in $72,000, as opposed to the original, where in a year I would be bringing in $30,000. So is my profit margin lower? Absolutely, my profit margin is lower. But because of the advertising spend, I'm selling it 3 times as fast, which means that I can rebuy from my manufacturer 3 times as fast, which means I push through more product in a year, and I can make a profit now of more than double the original amount if I was to just sell it without any advertising and let people buy it at their own rate. So now my $72,000 that I make a year, let's just say that I don't grow any other products over 30 years. And yes, we can talk about the fact that products have a life cycle and that product isn't going to sell forever for 30 years. All right. We can get into that, but let's not. Let's just keep things simple. If I did $72,000 a year using advertising over the course of 30 years times 30, that means that I would make $2.16 million with this business over the course of 30 years, doing nothing more than just selling one product online and advertising it. Tell me there is a better way to build wealth than starting a small e-commerce business that doesn't force you to quit your job, that doesn't force you to put your life on hold, that doesn't force you to say, I've got to go and I've got to get a $25,000 emergency fund, and I've got to quit my job to do this, and I've got to invest in this place and that place and do all these kinds of things. Like, no, you don't. 2018, you can literally start a business from your computer, buy a domain, get a website built for a couple $100, if that, right? Set up an online store using Shopify and get yourself a product that you know people want to buy, and then start advertising it and start selling it. If you don't want to get a website set up, find a product that people are already buying on Amazon and private label that product, and then start selling it on Amazon. Run some advertising to get people to go to your page and buy that product. It's that simple. And you can do it with a couple of hours a night, if that. And then once it's up and running, it really is just a matter of checking to see, hey, how's my advertising going? How's my product doing? What other products are people buying who are buying my product? Because maybe I can go to the manufacturer and I can get a complimentary product and expand my line and start growing even more. But it doesn't take a lot of time. It doesn't take a lot of energy. And if you do it right, when you put the effort in, the level of risk is super duper crazy low because you have the control over the entire thing. It is such a beautiful investment model. So we went over IRAs, Roth IRAs, cryptocurrencies, single stock trading, mutual fund trading, real estate investment, side hustle business, specifically e-commerce. Now, when we talk about real estate investment, again, that is another type of business. And if you're passionate about that, if you want to grow your wealth that way, there is huge money to be made in real estate. Otherwise, there wouldn't be 50,000 real estate gurus who are out there trying to sell their wares about how to run a real estate business, right? But do not be mistaken. That's not passive income. You're going to be running an actual business, right? So lower level of effort, side hustle business, e-commerce business, hugely profitable, low risk. Love it. All right. Y'all can guess which one I love the most. All right. So the last thing I'm going to do tonight, because I know we're running kind of long on this show. Sorry, got kind of excited. The last thing I'm going to do tonight is we are going to talk about a strategy for getting there. How do I go from where I am now, which is working paycheck to paycheck? It is tax season, so I might be getting a pretty decent return coming back. What should I do with this return money? So here is my recommended strategy. All right. The first thing that you start off with is the same thing that you hear from so many other real estate, or not real estate, I'm sorry, but so many financial people, right? Dave Ramsey is a huge one. He talks about you got to have your emergency fund first, right? You have got to have an emergency fund. And it doesn't need to be 6 months of your expenses to just start off, right? Get $1,000, get $2,000 in the bank, right? That's the first thing that you got to do. And the reason that you got to do that is because of peace of mind. If you don't have anything, if you are completely leveraged in all ways and you have no money in the bank, then when life happens, as it does, as it always will, you are going to have to go into panic mode. You're going to wonder how you're going to make it from day to day. And I tell you, I've experienced this every single year. It's something. Every year is something. It's got to do with a car needing new tires, or something else to do with a car, transmission going out, air conditioner going out at my rental property that I literally had to buy a brand new one from scratch, $5,000 out of nowhere. Like something in life is going to happen, whether it's a medical thing, whether it's a breakdown thing, and it's going to cost you a lot of money. And if you don't have money in the bank for that specifically, then it can kill you financially. So you got to have at least an emergency fund first. So that is step number one. Get your starter emergency fund. Dave Ramsey recommends $1,000. My wife recommends $2,000. And so that's what we keep, right? But that's whatever it is that is going to make you feel secure, that whatever pops up in your life that comes at you, that you will be able to meet it with whatever that amount of money is. Put that in the bank first. So $1,000, $2,000, whatever that is. Once you got that emergency fund there, the next thing that you need to do is you need to start a business fund, right? And that business fund is going to be the money that you are going to use to start your e-commerce business. Now, using the example that we had before, say that you wanted to get $5,000 in there, right? You want to get $5,000 into that fund as quickly as possible. So if you were to just say, hey, we're going to take, $200 every single month, and we're going to put it aside into the business fund. All right, so that's $2,400 in a year. Do it again, $2,400 in 2 years. You've got $5,000 put aside for your business fund. Now, in that time, in that 2 years, what you should be doing is you should be learning how Amazon works. You should be learning how eBay works. You should be learning how e-commerce works. And you might even be experimenting with some little things here and there, right? But over that time, that is where you learn how to run an e-commerce business. Once you've got that business fund of $5,000, and again, it doesn't need to be $5,000. I started mine with $200, right? It doesn't need to be, but I'm just using that $5,000 example. It could be much quicker, and it could be a lot lower amount, because once you start making profits, you can scale up, and you'll get that money a whole lot quicker making profits than you will from saving every month. But we're just using the saving example here. All right, so once you got the business fund set up, the next thing you do is you go ahead and you start your business. Now, what does that mean? Well, that means that you register your company, preferably an LLC, so that you have the liability separated from your personal finances. Set that up with your state. Get your employer identification number from the IRS so that you can separate all of that from your personal funds. You go to the bank, preferably a Black-owned bank. You go to the bank and you open up your business account, and you fund that business account with the business fund. Now, what does that do for you? Now, from the very beginning, day one, all of your business is separated from your personal. Your business finances do not mix with your personal finances. Learn from experience on that one over here. And best of all, whatever is going on with your personal finances that you take from your normal job every day, you can resume that behavior. So if you're huge on the Dave Ramsey thing of doing the debt snowball, or if you're big on any other of these ideas for how you can build wealth, you can do that completely separately with your personal finances. You can pay off all of your debts, and then you can turn around and you can fund your emergency fund at $25,000 or whatever 6 months of your expenses is, and then you can pay off the house, and you can pay off to this, and you can pay off to that. You can do all of that stuff over here with your personal money, right? But you've got your business fund that you've already got over here, and you've got your business set up. And you should, at this point, already have some ideas of what the products are that you are going to sell. So you start your e-commerce business, and you connect with the manufacturers, and you start getting your product, and you do your first order, which should be a sample order so that you can go and sell it and see if people buy it, blah, 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 right? We're not going to go into all those details. If you want to hear somebody talk about all of the details about how to do a great e-commerce business, check out Black Entrepreneur Blueprint with Jay Jones. He has multiple episodes where he breaks down exactly how to create a profitable e-commerce business selling on Amazon. And I remember listening to episodes. This man, he's had products that went out and he made $12,000 to $13,000 in profit in the first month, right? This guy, he's a guru. He's got it going on. So check out Black Entrepreneur Blueprint for all of those details. But here we're just keeping it on the surface. So you go and you start that business, you get your products, you sample them, make sure people are going to buy them, get your first order out, and then boom, you just start making money. And as money comes in, now you can scale that business, because since you don't have to worry about your e-commerce profits to pay for your bills because you still have your day job, you don't have to take money out of your company. You can just make it grow. So if you turn that initial $5,000 into $15,000, you can use that $15,000 to grow, whether it's getting more products or whether it is buying bigger shipments of the product that you already have. If it's in demand, whatever that is, you can scale up, right? And then once you make that more profit, you can reinvest and you can scale up and scale up and scale up. And because you're not worried about, oh, I got to draw money out of the company so that I can pay the rent this month or I can pay my mortgage this month, you can grow your e-commerce business tremendously in a very short period of time, right? So once you have done that, you've got this e-commerce business that is going gangbusters and you're selling, $100,000, $300,000, $1 million in product on Amazon or whatever platform, and that might sound like a lot of money. Go do some research. There are people left and right selling on Amazon, selling millions of dollars of product per month. And it's not just the huge companies that are doing it. It is a very profitable model. But once you're in that boat where you're bringing in all of these massive profits on your e-commerce business, now you can start looking at, okay, what am I going to do with distributions, right? I need to start taking distributions from my company because it's growing on its own. I have a lot of money in retained earnings just sitting there, which means that that money could be of better use elsewhere. So now we start talking about distributing that money to yourself from your company, but for what purpose? Well, this is where we get into things like real estate. If you do want to start collecting assets that pay you money, you can use your business and then pay yourself out of your business and then go and buy property with that money. And now you can start building a portfolio of real estate. You can go out and you can start buying art and you can get a portfolio or a collection. Collection is what they call it. And I know that Marjorie, you are going to yell at me for calling an art collection a portfolio. I fixed it. But you can start building up a collection of art. You can start building up a portfolio of real estate. You can start to buy assets that are going to appreciate over the long term. And when you've gotten to that point, you can look back at where you were and say, wow, without quitting my day job, I was able to start a business that made me a lot of profits. I was able to use those profits to buy a lot of property, and I was able to use those assets to build up my net worth to become a wealthy person in a lot less of the time that it would take for me to get my money back from an IRA. By the time that I'm collecting money from that IRA, which I probably continued to fund because I didn't need to use my day-to-day money in order to fund my businesses or collect my assets, I'm looking at it, I'm like, oh, this is cute. This is nice money for me to have on the side coming in. I'm really glad I was investing in that. But your real wealth is in your property. It's in your art. It's in whatever those assets are that you have been able to build with the money that you made from your business. It might be in other businesses, because once your business grows, you might want to purchase other companies that are profitable and make you even more money. Who knows? But the real key here is that you can do all of that while keeping your day job if you just take the time up front to save a little bit of money, start a business with it, and then turn that business into a profit center for you. And when we look at these little windfalls of money that come in once a year, like a tax refund, this is a perfect opportunity to take some money that you may not have been relying on to pay something off right now. It might just be a nice extra to have that comes in, and you can say, you know what? There's enough money here for me to go ahead and start a business. And then you do it. And you'll be amazed at the things you learn once you get started. You'll be amazed at how quickly money can be wrung from this tree once you get started. And then you'll be amazed at just how many other opportunities open up, how quickly you see what the market is looking for and what you can do to feed that market what it needs or what it wants in products, and have them turn around and feed you more money for your business and profits. I know I'm simplifying it seems, but it is really that easy. It's just a matter of us getting out of the mindset of thinking money is something that is scarce. Money is not scarce. There is so much money flying around this world. It is literally just in the air all around us. Our problem in our community is that we have been brought up to think that the only money we have access to is the money that our boss gives us. And that is just not the case. So we might start there. We might start with the only money I have access to right now is the money I get from this paycheck. But if I use a little bit of that, put it to the side so that I can start my own business and I can write my own paychecks, very quickly that scarcity mindset goes away, and it just becomes a matter of how can I create more money? And the last piece of this whole strategy, when you're in the role of that asset collector and you have all of this wealth, the next thing is, who can I give it to? Who can I give my knowledge to? The things that I learned that have helped me to become this wealthy person, who can I teach? Who can I give my money to? Because there's only so much that I can do with it, but my community needs, and the people in my community need, and the kids in my community need, and the sick in my community need, and I have it to give now because I was able to build all of this wealth. So who can I help? That is the last step. You go through this entire process from worker to business owner to asset collector to giver. And the thing that I like about this strategy that I just laid out is that you don't have to be 60 or 70 or 80 years old until you get to that point of being able to be a giver. When you look at the economy of today, you look at how quickly people can create wealth today through the internet, you can do this in a decade, maybe less. I know that sounds far-fetched, but it's not. You can become a very wealthy person by building a business using the internet in a short period of time, in an amount of time where you get to live and enjoy your money and give it away to other people and watch them enjoy it. And that is incredible. So I know I've drawn on about this for almost an hour and a half now, so I'm going to let you guys go. But just to recap all of it, when you're looking at things to invest in, what's the level of risk? What's the potential reward? How much control do I have? How much effort is it going to take? And what's the velocity of my return on investment? And then when you look at comparing all the different investment options out there, you have your IRAs, which are great, but you can't touch your money for a very long time. Cryptocurrencies and single stock trading is extremely volatile. The risks are massive. The returns are potentially massive, but you never know just when you should get out of them. And a lot of people don't get out at the right time. They either sell too early or sell too late, and they end up regretting getting involved to the first place. Mutual fund trading is less risky because you are diversified, yet there are a lot of fees associated with mutual fund trading. Real estate investment, it's not passive income. You're running a business. Understand that. Real estate investment is great. Those assets are great. There's a lot of money to be made, but it's a business and it's going to require a lot of effort. And then you have your side hustle businesses, and specifically I talked about the e-commerce business, which is low risk, high potential reward, high level of control, relatively low level of effort, and a very fast return on investment, or your velocity of your return, right? And then we went through that recommended strategy. You start out by getting your emergency fund, then you turn around and you build your business fund. Once you build that business fund, you start your business and you fund it with that money separately in an LLC. You start using all of your normal money to do normal people things again, and you keep that household income from the job separate from the business income that you have over here. And then you build your business, you build up your profits, you turn around and you use those profits to start buying assets. And then once you start collecting those appreciating assets and you're a wealthy person, you look around at the world around you, you say, who can I teach? Who can I give? Who can I help grow? Right? That is the strategy. If you have any questions about any of the things that we talked about in this episode, I want you to reach out to me directly. That is Gerald@buyblackpodcast.com. If you're listening to this on the app, you can just go to the contact tab and you can press the email button to reach out to me there, or you can call me directly from that app as well. If you haven't downloaded the Buy Black Podcast app yet, I highly encourage you to do that. You can find it in Apple or the Android store by searching Buy Black, Build the New Black Wall Street, and then you'll be able to download the app, and you will also find the episode that I did last week on CDs and why they are not a good place for you to put your money. I really appreciate you guys going for this ride with me tonight. I look forward to hearing from you, and with that, I am out, and I will catch you in the next episode.